Welcome back to the Deep Dive. It is Thursday, February 26, 2026, and today we are opening up the hood on one of the biggest financial engines in North America. I've got the Bank of Montreal BMO and the Q1 2026 earnings report they just dropped yesterday.
Right, and the conference call transcript, which is where the real meat is.
Exactly. And I have to say, looking at this stuff, I feel like I'm reading a riddle. Because if you just scan the headlines, it looks like an absolute boom time. Double-digit earnings growth, record revenue.
Yeah.
But then you look at the actual mechanics of the business, the loans, the deposits, the stuff a bank actually does day to day, and the business is shrinking.
Well, shrinking in the U.S. specifically, yeah.
Right, in the U.S.
Yeah.
So the mission for us today, as we take you through this deep dive, is to figure out how you pull that off. How do you shrink your way to a massive profit jump? Is that sustainable, or is it just, financial engineering?
And can they actually pull off this? They keep calling it a journey, this journey to a 15% return on equity that CEO Darrell White is so focused on.
That is the multi-billion-dollar question right there. And to answer it for you, we have to move past the press release and look at the trade-offs they made this quarter.
Yeah.
Because this wasn't just a good quarter. This was a very deliberate structural pivot.
Completely.
So let's start with the scoreboard. BMO posted adjusted earnings per share of $3.48. That is up 15% year over year. Net income is $2.6 billion, up 11%. And, in a mature industry like Canadian banking, hitting double-digit growth usually means you took some serious market share or the economy is just absolutely on fire.
And yet, neither of those things is strictly true here. The economy, especially in Canada right now, is tepid at best. And as we just noted, their loan balances are down. So what you're actually seeing here is the power of operating leverage.
Operating leverage. Break that down for us.
It basically means their revenue grew faster than their expenses, but more importantly, it's about efficiency. And this brings us right to the metric that management is completely obsessed with right now, which is return on equity, or ROE.
Right. This is their North Star.
It really is. Look at where they were a year ago. BMO's underlying ROE was sitting around 11.3% this quarter. It hit 13.1%.
Wow.
Yeah, that's a 180 basis point jump in 12 months. In the world of massive bank balance sheets, moving the needle that much, that fast, is incredibly difficult.
And Darrell White, the CEO,
Yeah.
was pretty bold about this on the call. He reiterated they have a target of 15% ROE by the time they exit 2027. And then he dropped this great soundbite. He said, "We are 60% of the way there in 40% of the time."
It's a great line for the analysts.
It is. It really projects confidence. It suggests they're ahead of schedule. But here is where I get a little skeptical. To get that efficiency, they had to spend a lot of money up front. I was looking at the severance charge in this report, $202 million pre-tax.
That's a lot of pink slips.
It is. And look, we never want to glaze over the human cost of that. It's real people losing jobs. But strictly from a shareholder perspective, when you're trying to figure out if this is a healthy bank, you have to look at the ROI on that specific charge.
Exactly. And they're projecting that this $202 million spend taking the hit now will generate $250 million in annualized savings going forward.
So the payback period on those layoffs is less than a year.
Correct. They expect half of those savings to hit in 2026 and the rest in 2027. So when you ask if that ROE jump is sustainable or just a parlor trick, this suggests it's structural. They aren't just, cutting the corporate travel budget. They are permanently removing costs from the system. They're basically saying, we can run this bank faster with fewer people.
Okay, so that handles the cost side of the equation. But you can't cut your way to prosperity forever. Eventually, you actually need revenue. And this brings us to the weirdest part of the report, which is their U.S. strategy. Because if I'm reading this right, the U.S. balance sheet actually shrank by about $6 billion.
It did, yes. Loans were down and deposits were down about 3 to 5%.
So explain this to me. Usually if a bank's loan book shrinks, it means customers are leaving in droves or the bank is terrified of the economy and scared to lend. But BMO's U.S. revenue actually went up 2%. How does the math work on that?
This is where we have to talk about capital recycling, or what Aaron Levine, he's the president of BMO US, what he heavily refers to as optimization.
Optimization is such a polite corporate word.
Right. But in this case, it actually accurately describes what they did. Think about a bank's balance sheet, like a giant warehouse. You only have so much space, in a bank's case, regulatory capital to store your inventory. BMO looked at their warehouse and realized it was full of really low-margin stuff.
Like what?
Like loans to corporate clients that barely paid anything above the bank's own cost of funds. Or on the other side, really expensive CDs that were costing them a fortune in interest to maintain.
So they essentially evicted the low-paying tenants.
Exactly. They just let those low-return loans run off. They didn't renew them when they matured. And on the deposit side, they let the hot money, the expensive certificates of deposit, they just let those customers walk out the door.
So they deliberately shrank the total volume, but the quality of what remained in the warehouse was much higher.
Precisely. And the proof that it worked is in the net interest margin, or IMI. That's the spread between what they pay for money and what they lend it out for. Their NIM jumped 13 basis points quarter over quarter.
13 basis point. Now, that sounds incredibly small to a normal person, but for a major bank.
Oh, for a bank with hundreds of billions in assets, 13 basis points is enormous. It is the difference between a mediocre quarter and a blowout quarter. It validates their whole strategy. They didn't just lose business. They fired unprofitable business. They happily traded volume for pure profitability.
Okay, I see the logic there. But there's a serious risk to that, right? If you shrink too much, you lose relevance in the market. You lose the relationship. If you tell a corporate client, hey, we don't want your low-margin operating loan, do they come back to you when they have a massive high-margin M&A deal?
And that is the exact danger. You can't optimize yourself into oblivion. But management seems to think they've hit the bottom of this process. They stated on the call that this optimization is 90% complete.
So the purge is over.
That's the signal they're sending. They are now forecasting for commercial loan growth to actually turn positive in the second half of the year. And here's a detail that really surprised me. Even commercial real estate, CRE, is showing signs of growth.
Wait, I thought CRE was completely radioactive right now.
It has been for the whole sector. But Aaron Levine mentioned they are seeing growth there now. That suggests they've scrubbed the bad stuff and are finding pockets of value even in a distressed sector. It tells me they are shifting from playing defense back to playing offense in the U.S.
So the U.S. is this great turnaround story, but let's look north. Because the narrative for Canada seems, well, it's totally different. It feels like a tale of two economies right now.
Oh, it absolutely is. You have the U.S. economy, which is surprisingly resilient, and then you have Canada. Piyush Agarwal, the chief risk officer, he did not mince words on the call. He specifically called out modest economic growth, softer labor, and a softer housing market.
Modest and softer are gentle ways of putting it. I mean, we are seeing rising unemployment in Canada right now.
And that links directly to credit quality. We saw delinquencies rising in the greater Toronto area specifically. It's the classic correlation that you lose your job, you miss your mortgage payment.
Plus the housing market itself. Inventory is up, sales are weak. They mentioned they're basically just waiting for the spring market to clear the backlog.
Right.
But I want to dig into a specific data point regarding consumer stress, specifically credit cards.
Right, the analyst question?
Yeah, Mario Mendonca, one of the analysts on the call, flagged that the impaired loss rate on credit cards was hovering around 6%. That seems incredibly high compared to historical norms.
It is elevated. Now, BMO claims it has stabilized, but if you're hitting a roughly 6% loss rate on cards, it tells you that the mass market consumer in Canada is tapped out. It's affecting that everyday segment much more than the premium banking segment.
And yet, despite all those cracks in the consumer foundation, BMO's Canadian business is holding up really well. And I think I found the secret weapon buried in the transcript. It's all about how they fund themselves.
Ah, the deposit story. Yes.
Yes. So BMO is apparently offering term deposit rates in the broker market that are nearly 100 basis points lower than their peers.
Yep.
Explain to me why that is a good thing. Because usually if you offer a terrible rate, nobody gives you their money.
So the broker market is basically where banks go to buy money from strangers when they're desperate. It is mercenary capital. Investors go to a broker and say, find me the absolute best rate. If BMO is offering 100 basis points less than their competitors, it means BMO isn't getting that money.
Which, again, sounds bad on the surface.
Right. But it's actually a massive flex. It means BMO doesn't need that expensive broker money. Why? Because they are absolutely winning the war for core operating deposits.
These are the everyday checking accounts from actual humans or businesses.
Exactly.
Yeah.
Checking accounts, payroll accounts. The money that sits there because it's just too much of a hassle for the customer to move it, that money is cheap. And their core deposits grew by 8%.
That's incredible.
It is the holy grail of banking. If you can grow cheap, loyal funding by 8% while your competitors are out there paying top dollar for mercenary broker deposits, you have a massive structural advantage. That is what protects their profit margins in Canada, even when loan growth is sluggish.
It's fascinating. They're basically insulated against the high cost of funds because their customers are sticky.
It's pure franchise value. You cannot replicate that overnight.
Okay, so let's pivot to the growth engines.
Mm.
Because while regular retail banking is sort of grinding it out, two other divisions are putting up huge numbers for BO, wealth management and capital markets.
Wealth was up 16% in earnings. That was largely driven by stronger markets, obviously, but also the integration of Burgundy Asset Management.
Mercury. They acquired them recently.
Mhm.
Is that just a pure asset grab, or is there a deeper strategy there?
It's definitely strategic. Burgundy is a high-end value investing shop, very prestigious. By fully integrating them, BMO isn't just getting more assets under management, they're getting access to a very distinct tier of ultra-high net worth clients. These are clients who don't panic and pull their money when interest rates move 0.25%. It heavily stabilizes BMO's fee income.
That makes sense.
Mm.
But the real star this quarter seemed to be capital markets. I mean, pre-provision, pre-tax earnings of $893 million. That's a standout quarter. And they kept talking about their dominance in a very specific niche.
Metals and mining. They have been ranked the #1 metals and mining investment bank for 17 consecutive years.
17 years. Okay, so they're clearly good at the mining sector. But why does that matter so much right now in 2026?
Think about the macro themes of the world right now. What is every major economy trying to build?
I mean, EVs, grid infrastructure, massive data centers for AI.
And what do all of those things require in massive quantities? Copper, lithium, nickel. We are in a global supercycle of resource security and the energy transition.
So being the mining bank isn't just about digging holes in the ground anymore. It's about being the primary financier for the entire global energy supply chain.
Exactly. BMO has spent almost 2 decades building relationships with the companies that pull this critical stuff out of the ground. Now that every government and tech company in the world is desperate for these materials, BMO is sitting right at the toll booth. That isn't just a lucky cyclical win. That is a structural moat they've spent years building.
It's a textbook example of being a specialist rather than a generalist. They aren't trying to beat the massive Wall Street banks at everything. They're just dominating the dirt.
And it is paying off handsomely.
All right, let's talk about risk and the future. We've painted a picture of a bank that is efficient, well-funded, and strategically very smart. But what could go wrong? First, let's look at credit quality. Total provision for credit losses, or PCL, came in at $746 million.
Right. And just for context, that's actually quite stable. There are no big alarms going off there, despite the softness in Canada we talked about earlier. And their U.S. portfolio is actually showing signs of improving.
Okay, so credit is stable. They also talked a lot about AI and technology. You know, every earnings call in 2026 requires an obligatory AI section. BO talked about their digital-first AI-powered strategy. Is this just corporate fluff, or are they actually doing something useful?
I'm usually pretty cynical about the AI buzzwords on these calls, but the use case they highlighted was actually highly practical. They rolled out a generative AI tool specifically for their commercial bankers.
To do what exactly? Look up policies.
Yes, exactly that. It solves the information bottleneck. Commercial banking involves thousands of pages of lending policies, loan covenants, compliance rules. It used to take a banker hours of digging to figure out if they could lend to a specific client under specific conditions.
And now?
Now they query the AI, and it retrieves the exact policy info in seconds. It's all about speed and efficiency.
So it's not about replacing the human banker.
No, it's about making that human banker 20% faster. And if you make thousands of bankers 20% faster, that's how you get your efficiency ratio down without having to fire the people who actually generate your revenue. It ties perfectly back to that operating leverage we started the show with.
That's a great point. But there is a looming cloud on the horizon, and the chief risk officer brought it up: the trade uncertainty.
Ah, yes, the USMCA renegotiations.
Right. And just to be clear for you listening, we're not taking a political stance on trade policy here. We're just looking at how these potential policies impact the bank's strategy.
Exactly. And for BMO, this is a known risk factor. BMO bills itself as the ultimate North-South bank. Their whole identity is facilitating business between the U.S. and Canada.
Right. So if that border gets sticky, if we see tariffs or delays or just political posturing that slows down cross-border trade flows, BMO gets hit much harder than a purely domestic Canadian bank would.
Correct. They are betting heavily on the continued integration of the North American economy. Furthermore, they're navigating a massive split in policy right now. They're trying to balance U.S. expansionary fiscal policy against Canadian economic constraint. It's a very tricky tightrope to walk.
So their biggest strategic strength is also their biggest geopolitical vulnerability.
That's the trade-off.
Okay, let's pull all of this together. BMO has basically spent the last year cleaning house. They executed this optimization in the U.S., firing unprofitable clients. They paid the severance to get leaner and more efficient. And now they claim the cleaning is 90% done and they are ready to grow.
That's the narrative. They are successfully navigating a very soft Canada by leaning on a strong U.S. operation and an incredible core deposit base.
So for you listening, if you're watching the broader economy, BMO's results are a fantastic real-world indicator. It suggests the U.S. is primed and ready to run, while Canada is still very much catching its breath.
Very well put.
But I want to leave you with a final, slightly provocative thought. Management is super confident they can hit that 15% ROE by 2027. But with the optimization tailwinds fading, since the easy cuts are mostly done, the bank now has to do the hard part.
Actually growing the loans?
Exactly. They have to actually grow loans in a high-rate, highly uncertain world, which requires a massive cultural shift. If you spend 2 years training your bankers to be ruthless, to say no to bad loans, to trim the fat, it becomes muscle memory. Can they suddenly switch gears from cutting to building without stumbling? Can you tell a banker who's been playing defense for 2 years to suddenly go out and take risks again?
It is a massive psychological shift. They've set the table beautifully, but now they actually have to serve the meal.
Well, they have an investor day coming up on March 26. I have a feeling we are going to hear a lot more about exactly how they plan to pull that off.
Oh, I'll definitely be listening to that one.
Same here. BMO is
Okay.
absolutely a bellwether to watch right now. Thanks for joining us on this deep dive. We'll catch you on the next one.